think what's coming down the pipeline hard and fast is going to be addressing carbon leakage in terms of a specific policy that can help shift the dial for us. It's that carbon leakage is the notion that you impose a tariff, a trade tariff, on the carbon intensity of a specific good. So a lot of countries, throughout the EU and the UK, we have the emissions trading scheme, which puts a price, or rather, you have to buy an allowance for each ton of carbon you emit. The EU is already moving forward on this. Well, just last month, they passed the final round of legislation, and it's coming into effect gradually. It's going to be fairly limited at first because it is a complicated process. It's easier to do on something like, say, steel, where it's a fairly contained commodity. You can, depending on where it was manufactured, understand, well, what was the energy, carbon intensity of the electricity and the facility and so forth. But something like a car that could have 1,000 of components, very difficult to actually calculate with great confidence what the carbon intensity is going to be. So that's slowly expanding. An alternative approach or to carbon leakage is what the US is looking to do with the green steel and aluminum pact with the EU. And that just sets a maximum floor of how much carbon, embedded carbon, can be in products. This is great because what we've done for a long time here in the UK is we've invested in decarbonizing our power system. That doesn't always reflect itself in the market value. China, which can build a coal-fired facility, cuts on its monetary costs at great environmental costs. So we're factoring those decisions into a market price, and that's one of the directions. The other point as well has to be on getting our head straight on critical minerals. Much like Russia has been able to do with gas, China has a huge opportunity to apply economic leverage over us from the critical mineral supply chains. We saw that in 2011 when they cut off supplies to Japan after a dispute over an island chain. A couple of things are possible there. One, we do need to think 20 years ahead because a modern mine takes a decade plus to fully bring online from idea to output. A strategic critical mineral reserve, I think, would be a very important way for us to build up supply stocks, which discourages countries from being able to abuse that leverage. It also provides a price modulator. It stabilizes prices. A big concern with some of these less liquid metals is that you can flood the market and the market price collapse, and then the investment you've been working on for 5 years is wasted. China's done that a few times very well. They will sometimes see prices slowly creep up. Western investors come into the market to try to develop that resource. China floods the market, and then when that asset goes into receivership, a Chinese-owned company buys it. So it's been a brilliant strategy, and we have to hand it to them. But the way you can mitigate that is through contracts for differences, for examples, where the state steps in as a buyer of last resort. They say, if you're willing to invest in a minor metal or an illiquid metal, because this wouldn't work for things like copper or even nickel and other larger lithium assets, but things like niobium, for example, might be viable. You sign a contract where hopefully you can get an off-taker for that company, and if not, the government will buy it from you or through a state entity or a bank. That sets a minimum floor price, but also if the price does exceed, the state can develop a return on it. By building up a strategic reserve, we'd be able to do things like release some more resources when prices do get high to the point of crimping down on available production. And then we can buy when prices collapse to make sure there is a bit of a floor so we can stabilize them that way. I think that's going to be really important, and it has to be a long-term plan over a 10, 20-year horizon because we do need to be thinking about a 2050 target, and it's not something we can fix soon.